I have to be honest, I stared at my screen yesterday for, I don't know, a solid minute, just waiting for it to refresh.
Mm.
You know that feeling where you think the data feed has to be broken because the numbers just don't make any sense?
Oh, yeah. It wasn't the feed, though. That was history happening in real time.
It really felt like it. If you were watching the markets close out yesterday, Friday, January 30th, 2026, you saw what people were already calling the Friday massacre.
And that's not an exaggeration.
No, we are not talking about just a red day. We're talking about a liquidation event, the kind that wipes out accounts.
It was visceral. I mean, we saw gold plummet over $400 an ounce in one trading session. $400.
And silver wasn't even a stumble. It fell off a cliff, down more than 20%.
A 20% haircut in a single day.
That is crypto volatility.
Yeah.
That is not supposed to happen in precious metals.
No, it was a total capitulation. The floor just fell out.
So that's our mission for this deep dive. We've been sifting through all the trading desk notes, the macro reports, the technical charts, really trying to answer three big questions.
Okay.
One, why did a single name, the nomination of Kevin Warsh, trigger a meltdown that erased weeks of gains?
Right.
Two, is this the great metals bubble finally bursting, or is this just a vicious, healthy shakeout?
And three, probably the most important one for anyone listening.
What do the charts actually say about Monday morning?
Because if you're holding a position right now, your stomach is probably in knots. You need to know if we're catching a falling knife or if this is, the buying opportunity of the decade.
And we absolutely have to get into the mechanics here.
Yeah.
Specifically, that gamma squeeze that snapped back, because without that, none of this price action makes any sense.
It really doesn't. You can't explain a 20% drop with just one news headline. There was structural leverage at play here, big time.
Okay, so let's set the scene first, just to get the scale of this. Friday morning, the mood is already, a bit tense.
Mm.
The Dow ends up dropping 500 points. Bond yields on the 10-year spike back up to 4.25%. But the real violence, the real horror show, was in commodities.
A bloodbath. It was an absolute bloodbath. You mentioned the gold drop, but let's put that $400 decline in perspective.
Yeah.
For the last 20 years, if gold moved $20, maybe $30 in a day, that was a headline.
A huge deal.
A huge deal. Yesterday, it lost the entire $5,000 handle.
And that $5,000 level was so psychologically huge, it felt like a fortress.
It really did. Gold fell from all-time highs to trade, briefly below 5,000, closing right around 50.30. That's an 8.5% drop.
And what's supposed to be the world's most stable monetary asset.
It just doesn't happen.
But silver,
Yeah.
wow. Silver makes gold look like a savings bond.
Silver was the epicenter. It just smashed through $100, which, by the way, everyone thought was the new unbreakable floor.
Everyone.
And it traded all the way down into the low 90s. You saw Prince at 91, maybe even a wick down to 90.
Just brutal. And this wasn't isolated, was it? It wasn't just a silver and gold thing.
No, this was a get-me-out-of-everything trade. Copper, which had just hit that incredible $14,000 a ton milestone, gave back almost 4%. Platinum took a beating.
The only thing that was green was the dollar.
The wrecking ball. The greenback. When panic hits, cash is king.
Okay, so the market imploded, but every explosion has a spark. And yesterday, that spark had a name. Kevin Warsh.
Or Walsh, if you were reading some of the panic newsletters that went out a little too fast. But yes, Kevin Warsh.
So Donald Trump announces Kevin Warsh as the nominee for the new Fed chair to replace Jerome Powell. On paper, it's just a personnel change. So why did it nuke the entire metals market?
Well, it comes down to market memory versus, the current reality. Markets are efficient, but they're also emotional.
Mm-hmm.
And the market hears Kevin Warsh, and immediately it flashes back to his time as a governor at the Fed years ago.
Where he had a very specific reputation.
Oh, yeah.
Yeah.
Very specific reputation. He was known as a serious hawk.
Okay, let's unpack hawk for anyone who doesn't speak central banker.
Okay.
We're talking about someone who hates inflation more than they love employment.
Precisely. Yeah. A hawk wants higher interest rates to crush inflation. They want a strong dollar. A dove wants low rates to stimulate growth.
And high rates and a strong dollar are basically kryptonite for gold.
They are, because gold doesn't pay you a dividend, it doesn't pay interest. So if rates go up, you'd rather own a bond. It's the opportunity cost.
But the computers just saw the name?
Yep. The algo bots, the knee-jerk traders, they saw the name Warsh, their databases flagged hawk, and they just slammed the sell button.
Assuming high rates are coming, so don't meddle. Buy dollars.
And you saw it immediately in the currency markets. The dollar rallied about 70 cents on that news,
Wow.
which mechanically pushes gold down. But, and this is the key insight from our sources, the market might have gotten this completely wrong.
Okay, this is the nuance I think a lot of people missed in the panic. Warsh was a hawk. But lately, he hasn't been singing that same tune, has he?
Not at all. He has pivoted pretty significantly. In just the last few months, Warsh has been publicly arguing for lower interest rates. He's aligned himself with the administration's desire for cheaper money.
So he's looking less like an inflation fighter and more like a yes man for the administration.
That's the theory. So the market priced in hawk Warsh, but what we might actually be getting is dove Warsh. We could look back on this and see it as a massive, massive misinterpretation.
That's fascinating. But there is another layer to it, isn't there? Because even if he's a dove now, it's all relative.
That is the critical point. Yes.
Yeah.
Even if Warsh wants lower rates, the market might just see him as more hawkish than the other candidates on the shortlist.
So if everyone was betting on a candidate who wanted to slash rates to zero tomorrow,
And they got Warsh, who maybe only wants to cut them slowly, that's still a hawkish surprise compared to expectations. It's a repricing of risk.
the market realized it might not get the free money party it was hoping for.
Not as fast, anyway. But let's be honest. A single nomination, even for the Fed chair, it shouldn't cause a 20% drop unless the market was already, broken.
Right. A gust of wind doesn't knock down a strong house. Warsh was the pin, but the bubble was already there. We have to talk about the parabolic run-up.
The charts leading into Friday were they were vertical. I mean, literally vertical.
We were seeing daily moves that just defied physics. Gold gapping up $200 at the open. That is not normal.
It's not normal, and it's not healthy. Silver jumping $8 or $10 in a session, that's mania. That's euphoria.
I was looking at the technicals before the open Friday, specifically the RSI, the Relative Strength Index. And for anyone who doesn't watch charts, it's basically a speedometer.
Good analogy.
Right. Usually, if the RSI goes over 70, you'd say the asset is overbought.
Yeah.
It's running too hot. Gold's RSI hit 90.
90,
Yeah.
which it's practically unheard of for a major asset. Hitting 90 isn't just hot, it's the engine melting down. It basically means that everyone who wanted to buy gold had already bought it.
So there was no fresh capital left.
The tank was empty, the car was doing 200 miles an hour, and there was a brick wall right ahead.
And this is where that gamma squeeze concept comes in. Goldman Sachs had a really interesting note on this. It explains the why the move up was so fast and why the crash was so violent.
Yes, the gamma squeeze. It sounds complicated, but it's really a pretty simple feedback loop in the options market.
Okay, break it down for us.
So you have all these investors, retail, hedge funds, buying massive amounts of call options on gold and silver. They're betting the price goes up.
They're not buying the metal itself, but the right to buy it.
Exactly. And on the other side of that trade, you have a bank, a market maker. They sell you the option, but they don't want to gamble. They want to stay neutral. So if they sell you a call that pays out if gold hits 6,000, they're exposed. They have to hedge that risk.
How do they hedge?
They have to go out and buy the physical gold or the futures contracts.
So investors buy calls, which forces banks to buy gold, which makes the gold price go up.
And as the price goes up, those options get more valuable, so the banks have to buy even more gold to stay hedged. It's a self-reinforcing loop. It just sucks the price upwards mechanically.
But Friday showed us the dark side of that loop.
The gamma snapback. The second the price started to fall, triggered by the Warsh news, all those market makers were suddenly overhedged. They had too much gold.
So they have to sell.
They have to sell immediately, and their selling pushes the price down further, which forces them to sell even more.
It's the elevator going up, and then the cable snap.
It's the elevator shaft.
Yeah.
Exactly. The same mechanic that created the melt-up just amplified the meltdown. It's a double-edged sword.
We also can't discuss this without talking about the dragon in the room, China.
The Shanghai Premium. Yeah, you can't ignore it.
It's been wild. For weeks, gold and silver have been trading way higher in Shanghai than in London or New York.
It was a pure arbitrage play. And it showed just how desperate the physical demand was in China. I mean, you have to understand the context there. The real estate market it's collapsed. Their stock market's been shaky.
So the public is fleeing into safety.
They're pouring everything they have into metals.
I read in the notes that the Shanghai Futures Exchange actually had to step in.
They did. They were terrified of a disorderly market. They raised margin requirements. They changed trading limits. There was even a report that China's only pure play silver fund had to halt trading.
Wait, they had to turn away new investors.
They literally couldn't take the money fast enough. They couldn't find enough physical metal to deploy the capital. That is the definition of a supply squeeze.
Wow, that's insane. So you have this physical mania in the East colliding with derivatives leverage in the West.
It was a powder keg.
And Kevin Warsh lit the match.
Hmm.
So the keg explodes, the dust is settling. Now we have a market that is just deeply divided. The forums, the analyst notes this morning, it feels like a religious war between the bulls and the bears.
It really is. And the confusing part is both sides have incredibly compelling arguments.
Okay, let's steelman the bull case. If you're buying silver on Monday, what's your thesis? Why are you catching that falling knife?
The bull thesis is simple. The Fed chair doesn't matter.
That's a bull take.
Well, their argument is that this is a physical shortage, plain and simple. We need silver for the solar panel build-out, which is accelerating. We need it for AI infrastructure servers, chips, contacts. It all uses a ton of silver. We need it for electrification.
And the mining supply just isn't keeping up.
It's flatlining. We're not finding big new deposits. So the bulls look at Friday and they say, that's just paper. They're saying futures contracts being dumped on a screen in New York doesn't change the fact that Samsung and Tesla need physical metal to build their products.
They point to the lease rates being high, right?
Yeah.
It actually costs money to borrow silver.
Exactly. It's tight. If you need 1,000 bars of silver for your factory tomorrow, good luck finding them without paying a huge premium. The bulls believe the price has to go higher to destroy that demand.
And $100 silver clearly didn't do that. So for them, Friday was a gift, a clearance sale.
That's the thesis.
Okay, now flip the coin. The bears. Why do they think this was the top?
The bear case is built on one word: euphoria.
Right.
They argue that when your Uber driver starts giving you tips on silver mining stocks, the top is in.
The classic sentiment indicator. When it hits the mainstream news, it's too late.
It works for a reason. The market positioning was so crowded, everyone was on one side of the boat. The bears argue this was a speculative bubble fueled by cheap money and hype, kind of like the meme stocks.
And they're worried about that whole monetary debasement story falling apart.
Exactly. A lot of people buy gold because they think the dollar is being printed into oblivion. If Warsh comes in, strengthens the dollar, tightens the money supply, that trade unwinds. You don't need gold if the dollar is strong.
Plus, there's the mechanical issue of month end.
You can't overlook that. Friday was January 30th. If you're a big pension fund and your gold holdings just doubled in value, you have to sell some.
Just to rebalance.
Right. If your rules say 5% gold and suddenly you have 10%, you sell half, it's automatic. So you had profit taking from the big whales hitting at the exact same time the news broke.
So who's right? Structural bull run or speculative mania?
If you synthesize the sources, it looks like both are right, just on different timelines.
Okay.
The long-term demand for metals, the AI and solar story, that is real. That's not going away. But the price action we saw in January, that was pure speculative froth.
It was a bubble on top of a bull market.
Exactly. And we just blew the froth off. Now we find out where the beer really is.
Which brings us to the part everyone is waiting for. Monday, February 2nd.
Mm-hmm.
What are the technical charts signaling?
Short term. We're probably looking at a dead cat bounce.
I always hate that visual, but explain it for us.
It's a grim trader term. It means even a dead cat will bounce if you drop it from high enough.
Right.
Basically, when a market falls this fast, it snaps back up just because the short sellers are covering their bets to lock in profit. It looks like a recovery, but it's often a trap.
Looking at the 4-hour charts for silver, the analysts are flagging a specific level.
They're watching the 95.08 area. Remember, we closed in the low 90s. The momentum indicators, like that RSI, they've reset from overbought to oversold really, really quickly. So the elders will likely buy the open.
So we could see silver rally back to 95, maybe even 98.
And gold could stabilize and push back towards 51 or 5,200 through the week. But, and this is a huge but, the momentum is damaged. The chart is broken.
So you have a lot of bag holders.
A ton of them. People who bought at the very top. As the price comes back up, they are just praying to get out at break even. So they become sellers on the rally.
It creates a ceiling, a wall of resistance.
Exactly. So the consensus is to be very, very careful on Monday and Tuesday. If that bounce fails, if it hits 95 and just rolls over, we could be looking at much lower prices.
Despite that caution, I did see a note from a major bank still floating an $8,000 target for gold.
The long-term structural bulls, they haven't flinched. They see this volatility as the price of admission. They believe the destination is 8 or even 10,000, and Friday was just a noise event.
That takes nerves of steel to hold through a drop like that.
It does, and you have to watch the dollar index, the DXY. If the dollar keeps strengthening next week, that is a massive headwind for gold. You usually don't want to fight the currency trend.
So let's wrap this up. The so what for the listener. We just watched history. Billions of dollars vanished in hours. What's the takeaway?
I think the first lesson is just gravity. Things cannot go up in a straight line forever. When you see a melt up like that, you have to recognize that the risk of a crash is actually increasing every single day.
It's so counterintuitive. When the price is highest and everyone's celebrating, the risk is at its max.
It is. And the second lesson is that this market is jittery. It's trading headlines, not fundamentals. If you're playing in this space, you're playing a game of psychology, not just economics.
One of our sources had a piece of advice I think is worth highlighting. It was simply, do nothing.
It is the hardest trade to make. It really is.
You see the red, you want to sell. You see the green after a drop, you want to buy.
But in this kind of volatility, when the VIX is spiking, trying to trade is like trying to catch a falling knife, you're probably going to get cut. Sometimes the professional move is to just sit on your hands, let the dust settle.
Wait for confirmation.
Exactly. Don't try to be a hero.
I want to leave everyone with a final thought for the weekend. We spent a lot of time talking about paper markets, options, futures, Fed chairs.
The financialization of it all.
Right, but just step back to physical reality. If the world builds a gigawatt of solar next week, if AI data centers order 1 million new chips, they need physical silver.
You can't build them with paper contracts. You need the actual element, Ag.
Exactly. So does the name of the Federal Reserve Chair actually put more silver in the ground?
Yeah.
Does Kevin Warsh create new mines?
He certainly does not.
Or is all of this sound and fury just noise, distracting us from a simple geological reality? That's the question.
And that is the billion-dollar wager.
We'll be watching the Open closely on Monday. Thanks for taking the plunge with us.
Always a pleasure.
Stay safe out there.